YouTube here. All right, we are live. Eric, take it away, man.
Welcome one, welcome all to the greatest show on the earth. No, thanks for coming to Office Hours, everyone. Hope you are having a great Friday. It's been a wild week for me. I was all the way up in snowy Indiana and not snowy yet, but cold Michigan not too long ago. And a couple of flights later, a couple of crying kids and sleepless nights. We got a few planes back to Brazil. So I am back in Brazil now with our family in the warm and tropical weather and still doing PML deals. Surprise, surprise. So Justin and I are so glad to have all of you on here. And thanks, Ben Bayless, for showing up. Brenda, great to see you. We've got Geraldo Pina Neto. That sounds like a Brazilian name. So
It is.
Fala português, você é brasileiro?
Falo sim, nasci no Brasil, mas criado aqui nos Estados Unidos.
Parabéns. Awesome. We've got a fellow Brazilian. I'm Brazilian on paper. I've got my permanent residence, so that counts for something, right? I go to the churrascos here and all that.
Oh, you're one of us, man.
Yeah. Thanks for joining us, Geraldo.
Thanks for having me.
Yep, we got Erlene Peck. Thanks for joining too. Good to see you. Awesome. So, and I think Kelly Bennett, I think I hit everybody, and we've got a few robot note takers. Thank you, robots, for joining here. We wanted to have some more topics for the office hours and then jump into the Q&A. So one topic that I wanted to talk about a little bit more is just the power of private money, and specifically the power of fast cash offers, because I preach this every single day, but I still forget about it. This is our most powerful weapon that we have, that hard money loans can't compete with, that banks can't compete with. And no matter what side you're on, right? If you're on the borrower side, like, hey, I want some money quick to do a fix and flip, or if you're on the lending side, like, I want to lend my cash out, the power of private money for a fast and low ball cash offer is incredible. So let me tell you guys a story. When I first got into Gator, I was wanting 10% a month, so like 120% a year on my deals, just because, you know, you hear these stories from Pace Morby, and he's like, oh, well, I double my money all the time. So that was kind of the mindset that a lot of us got into. And I was like, okay, well, I'm going to charge a lot and just see if somebody will take it, you know, 10% in 1 month. Why not? And a lot of people were saying no to that, but I'll tell you how I got my first ever deal that I actually funded. Was a guy on the phone that said, hey, I heard you did private money. And I said, yes, I do. I'd be glad to fund a deal. He's like, okay, well, I've got this house. It's worth about 100K as is, has a tenant in it, no repairs needed. And I've got this great deal where I can purchase it for 60K, but I need to purchase it in 3 days. So he actually already understood the value of a lowball fast cash offer, right? Because on the open market, that house should have sold for 100K. He already understood that if I tell the seller, who is very motivated for money, that, hey, I can close super quick, I know you just guys want to get out of it, 60K is all I got, take it or leave it, here's my lowball cash offer. He understood that. And that's why he was able to lock up such a good deal. But then he didn't even have the funding for it. So this guy was kind of gutsy. He didn't even have it. And he was calling me, asking me to fund it 3 days later. And this is in the Midwest. This was an interesting story, but basically I told the guy, and actually I need to back up a little bit. It was about 2 weeks before he's called and said he needed that house. About 2 weeks before, he was saying, hey, I'm just looking to connect with more private money people in general. And I said, yeah, that's great. I can do it. I'll give you the cash you need. I'll close quickly. I'll make all the stuff happen. And I'm going to charge you 10% in 1 month. And he said, no, that's ridiculous. That's 120% per year. No way I'm ever going to pay that on any deal. I won't do a deal with you. Then 2 weeks later, he calls me and says, hey, you know when you said you could close super quick for 10% a month? I'll do it for 1 month. So I pay 60K and then I get back 66K a month later. That was the first private money deal that I ever funded. And I ended up making more than 6K because he extended for another month at the same rate and then had a little bit of late fees in there. So it was like 13K or so I made on that 66K. First ever Gator deal that I did. And what's incredible is he said yes to that just because I was able to explain the power of doing a really, really fast cash offer. I was able to say, like, look, I know I'm more expensive. If you've got time to go to a credit union or a bank or hard money lender, then yeah, sure, you can get a lower rate. But I'm here when you need that fast cash offer because I might charge 10%, which is, $6,000 in a month, but otherwise you wouldn't be able to get a house for basically half price, right? So we understood that and we were able to make that happen. And now with our rates being drastically lower than that, we're 15% in 6 months instead of like 15% in 1 or 2 months. We're way lower than that. The same principle still applies though, right? Our fast cash offers is like, if you can lock up a property low for cash, go do it. And once you have that mindset, the world is your oyster because you see all these real estate deals where you don't have to think like, oh, dang, that's a great deal. Someone's going to lock that up cash for a low price. You can be the one that locks that up. So with that being said, that was my first ever deal. And that principle is powerful when you leverage it. So do you guys have any questions about that story or about just the principle in general of using private money for fast and low cash offers?
Well, I have a question.
Sure.
What would, so you went from 10% a month to 15% for, I think you said 6 months. Did I get that right?
Yep.
How did you, obviously that's a big spread, right? It's a big difference. What kind of process did you go through to say, obviously in your mind, 10% a month was too much, and then you went for 15% in 6 months, which obviously is a great deal for the borrower. How did you go from 10% a month to 15% for 6 months, and how did you kind of land on that as the right number or a good number or whatever the case may be? Because I'm curious, it seems like potentially, and you might be leaving a lot of money on the table, but obviously you've gone through the process, so you came to a determination on that 15% through some process. I'm just curious how you got from one to the other.
Yeah, for sure. And I don't even know if I'll have a great elaborate answer for you here, but there is kind of a trade-off on how much of a ridiculous rate the borrowers will accept and what quality of borrowers there are and how much they're going to fight you for it or make you go through a foreclosure. Before Justin and I partnered, I closed lots of deals, good, bad, and ugly. Some of them made me over $100,000 net in my pocket. Some of them I'm still dealing with heartburn with and going through foreclosure and lots of stuff, right? So I was like the cheetah avatar when you look at different investment and business apps. I was like, just go, jump. Things might go well, things might go horrible. You learn a lot, and I did a lot. I made a lot of money. Some deals are still crappy. I got some scars, but I learned a ton from like foreclosure, deed in lieu, where they deed the property over to you, LLC takeover. I've done pretty much the whole gamut of different recovery mechanisms when a PML deal goes wrong. But we found that the 10% in 3 months and then 15% in 6 months, which is where we're at right now, is kind of the sweet spot where you can still get borrowers who are reasonable borrowers and who will not have a super high chance of default and still be repeat business. Because if you're doing 10% a month, it's really, really hard to have repeat business, right? Like why somebody's only going to go to you if they're super, super desperate, right? So to get repeat business at those rates, you're not going to get that. But at our lower structure now, it's still too expensive for a lot of people. They're just like people who are doing tons of deals and they use hard money loans. They've got so much cash they don't care about the down payments and the fees for hard money loans, which we don't have. So it's kind of a balancing act between getting repeat borrowers and getting enough business versus still making enough on our deals to pay for our systems, our processes, our employees, pay the capital partners and funders, and still have enough left for us. But there's a lot more to this story because these are the rates that we're at right now. But my first inclination was to test lower. to say like, hey, let's just see if we'll get way more lending volume testing lower. But if you follow Alex Hormozy, it's actually kind of the opposite business advice. Test higher first, right? Just see like if I go slightly higher or slightly lower in my rate, what's the supply and demand curve? Am I going to get a lot more or a lot less? So there's a lot more to that. But for now, these are the rates, with the only caveat that, like, if somebody comes up to me and says, hey, I need $2 million in 2 days, I'm not going to give them our low, like, bread and butter rates. If it's just a wild goose deal where they need a lot of money, and basically the whole Creative Cash Partners team, Justin and Mariel and I, have to divert all of our focus and make sure the 2 million deal makes sense. And then when it seems to make sense, just push everything off and get it done, then we're still going to be a little bit higher. Not 10% a month probably, but definitely higher than our just standard 10% in 3 months and 15% in 6. Does that answer the question a little bit, Kevin?
Yeah, I get it. I mean, I'm with you. It's always that balance of trying to find, the sweet spot. So it's just interesting to hear from, somebody else's perspective that lives and breathes in the PML world. So, kind of how you found your spot. I have a different process. It doesn't mean mine's right or any better. It's just we're all, it's great to learn from other people, hear what other people are doing, and because you can take a lot away from that and digest it and see how that might work in some scenarios for you. So appreciate it.
Yep, no problem. I guess there's another topic I didn't really cover, and I don't want to dive too deep into it, but like usury laws and legal fees, for example, in Michigan, where you're at, like, even in some cases are 10% in 3 months or 15% in 6 months is above usury for some states. We'd have to do a partnership instead of just a regular loan in there. But the legal risk is higher when you're at those kind of deals where you're at 10% a month, because if I'm at 10% in 3 months or 15% in 6 months, a judge can look at that and say, yeah, well, it's kind of high, but that is what it is. The higher and higher your fees get, the more chance that if they fight it or contest it and a judge looks at the paperwork and says, oh my goodness, that's outrageous, we should toss this interest and not let them foreclose or whatever. So the higher and higher you go, it's riskier. You can also do it as a partnership, which a ton of people will accept, like, hey, I'll give you the money and we're going to split the profits 50-50, which makes your potential profit a whole lot higher as a private money partner or lender. But it also is riskier because when the profit dries up, like, you're left with nothing with your money or even a loss that you're splitting. Versus if you're a lender, then they're obligated on paper, personally guaranteeing it in most cases, to pay you back that flat percent amount or what you negotiated.
Sure. Do you, is it okay if I ask another question? I don't want to monopolize things. So.
No, go ahead.
You talked about some, sour deals, if you will, that you've had to foreclose. I'm experiencing my first one, but I don't actually look like it as a sour deal. We're actually, we're taking over a house next week that we funded. We were in first lien position, so just full disclosure, we put about $110,000 into the deal. The house appraised for $230,000, and
awesome.
They did the rehab, and we're getting the whole house.
There you go.
I mean, so it's I don't want the house in essence. I'd rather have just gotten my money back, but it'll take probably a couple months to sell or whatever, and we'll make way more money than if we actually just completed the transaction. My question to you is, when you experience those, and this is my first one, did you consider like maybe renting that out, or did you always want to dispo it and just get rid of it? What's your philosophy when you have to take over a home or foreclose? What do you just immediately go, let's sell it, or do you ever think, hey, maybe we should rent this one out? I'd love to hear kind of what what your thought process is when that happens.
Yeah, so I mean, if my primary goal, for example, was to build a rental portfolio in Charlotte, North Carolina, one of our top places, as well as be a lender in Charlotte, North Carolina, then I would consider that. and we might be there someday, but right now, Justin and I's pure focus is to be lenders, not a portfolio builder. We do have a side business where, like, as part of the lending, sometimes we'll do a partnership deal and provide funds for a portfolio, and then we get a small ownership percentage. So that gives us ownership benefits and depreciation and all that. But for Justin and I to just be like the landlords, the owners of some single family homes, that's not in our cards right now until we have more processes and systems set up. So in general, when when things start to go south, I just say take action quickly, because you're going to regret it, especially if you're in second position. I've been in both second and in first position. It's way better when things are south when you're in first position, because in second, you're at the mercy of first. And if first starts charging default fees and default interest, you're just going to get compressed out of there, and there's going to be no value left of the property for you unless you were just super, super low loan to value. So anyways, for this one, and for anyone, like, when you're in first position, just take action quickly. Don't delay. Try to negotiate with the borrower to see if they'll do a deed in lieu with you after the fact. You can't do a pre-signed deed in lieu, like before you even close the deal and give them the money. After they've already defaulted, if they'll do a deed in lieu, that'll relieve you of a lot of headache. Just make sure you get a clean title policy simultaneously with the deed in lieu. But whatever you're going to do, like if they're just going to deed the house back to you, if you're going to foreclose on it, if some other states have some other mechanisms and things, but whatever you're doing, get good legal advice and just do it quickly, because the more you delay, the longer it is before you'll get your money back.
Yeah, fortunately, this particular borrower is not, they're not putting up a fuss at all. They're just like, they're in a bad spot, and they're just like, take the house. I get it. We're like, okay, this is the easiest way it could have gone. So we're pretty thrilled about that. And again, the house is worth a crap ton more than we put into it. So anyways, I'll let somebody else ask questions. Appreciate it.
Yep. Well, that's great, Kevin. And I know Ben's got questions. You see Jeremy here. Thanks for joining, Jeremy. Saw Norm Fuller hopped on. I don't know if you're still here, Norm, but thanks for joining. This principle scales, by the way, and we don't want to be like sharks or predatory lenders, but when you are doing rescue loans, you get into that position. So for example, you loaned 110K, house is worth 230K, you might be able to sell it and double your money. People are doing that at bigger and bigger and bigger scales. We did a house that we are all in for 1.1 million, and there's a good chance that they will not be able to pay us back. And the as-is value is 2.6 million, or possibly higher if we divide up the land. So Justin and I have some big opportunity to either get a big paycheck if they just pay us back regularly, because that was a higher rate one, or a much, much bigger paycheck if they don't, because then we're going to be rejoicing. Like, I mean, and this is this was not like grandma's house that she lived in for 40 years that we're going to foreclose on. Like, this was a pure business transaction. They signed the affidavit. They knew exactly what they were getting into. They were taking a business risk. We were taking a business risk. So we've got a chance to more than double what we put into it. And besides that, like, one of the most famous cases is the Fort Worth commercial building. If you want to Google that later, check it out. The property was about $100 million, but commercial real estate kind of went up and down. So it's, it's a little bit debatable on how much it's really worth, but a $100 million property. First lien holder was in it for $20 million. They didn't pay them back. They foreclosed. They won that property in Fort Worth for $20 million. So that's $80 million in equity that you got. That's just life-changing money, right? Unbelievable. And of course there were lawsuits. The previous owners of the property filed a suit, but they lost the suit because it's the way the state says it. You don't pay back, you foreclose, you get the property's there. Like, they lost that lawsuit, but they tried to get it back, of course. Nobody wants to lose $80 million worth of equity, but this whole principle, like exactly what you're experiencing, you put in 110K and it's worth double. It happens at scale as well for more and more and bigger and bigger deals.
Yep.
Good luck to you guys. Hope it works out.
Thank you.
Eric, we can maybe take Ben's question, but I also, with Jeremy on, it would be great to get Jeremy to chat a little bit about the power of cash buying, since he's done that on a number of deals, and he would be able to speak specifically to exactly how powerful that is.
Yeah, for sure. I know that I've had Ben hanging out for a while.
Yep.
Ben, let's grab your question quick and then hop to Jeremy.
Yeah, thank you. So real quick, when you mentioned first and second positions, what were you talking about? Or first and second place?
So if Justin and Feliz make a delicious Filipino lunch and it's on the table, first position is the first person that sits down to eat it. Second position has to go and eat and see if there's any soup left in that bowl.
Yep.
First position is the first person. So if there's a lot of liens against the property, we say first to eat, right? Like if somebody's got a home mortgage, that's usually the first lien. If they get a HELOC, like a line of credit for their home, that they took out another loan against it, that's a second lien. If the roofer did some work on the roof later and they never paid that poor guy, he can lien the house for a third position lien to try to get money from the house to pay out since he's having a claim against the house now. But we have those three liens now: the mortgage, the HELOC, and the roofer. If that property goes to foreclosure and it goes to auction, then the liens will get paid out in order if there's anything left, right? So if first position says, hey, I'm owed 150K, and then the auctioneer sells it and it sells for 150K, that 150K goes to the first position lender, and then the second position and third position just lost their money, right? That's why second position is riskier. Third position is much riskier. Like as you go up and up and up, it's just riskier and riskier because everybody else gets paid out before you do.
Got it.
Do your percentages that your lending percentages change based on the position? So if you're in first, you're going to pay X, and if you're second, you're going to pay. I'm assuming you would never do third.
Yeah, absolutely right. We would never do third. And in second position, I only want to be. I used to do some second position deals that have paid out a lot of money, but it's very, very risky and precarious. The first position loans can blow up on you. It's not a good spot to be in. So, like, the only time I would do a second position loan, kind of an oddball deal now, is if I'm behind like a credit union that is very foreclosure averse, like not sharky or hungry, not attacking, and it's a very, very low value. So, for example, somebody's got a house that's worth $1 million. There's a 200K first lien from a bank or credit union, not a hard money lender, not a private money lender that's going to foreclose quickly or charge a bunch of extra fees. And we're basically at 20% loan to value, right? 20% for the credit union on the 200K, and then there's the other value all the way up to $1 million. I'd loan 200 or 300K in second on that because that's a wonderful house to get if I can just take it over. But other than that, I really don't want to do second position.
Right.
And my fee would be higher than first position fee. So since I'm second position, I'm going to charge more than our regular flat rates. Yeah. Okay, awesome. Jeremy, talk to us about how powerful it is when you've got cash to make a quick cash offer, or you've got a partner, private money partner, lender who can do fast cash to throw some offers out there and lock up some properties.
Well, I'll tell you, it's really incredibly powerful. First of all, I was always, when I came in with an offer, I wanted a resounding no. Absolutely no. Not, I wasn't trying to make them mad at me, but I wanted to know that there was no possible way they were going to take what I was offering. And then, sometimes it's more than just having cash and being bold, but also knowing how to talk to people so that they aren't upset with you. I don't really know how to tell you how to do that, but I would make it clear that we weren't done talking. I'm just going to throw this number out here and we'll go from there. But I definitely wanted to hear no. Before I would do that, if I would spend time, not a lot of time, but I would spend time just getting people, anybody I could talk to, the real estate agent, to give me as much information, little, what would seem like inconsequential information about what was going on, who was involved, who moved, who got a job, if there was a divorce, all sorts of things like that, to help me decide how aggressive I was going to be. Sometimes you would get a little bit of the feeling if someone was just a jerk, or
Mhm.
they were hasty. Lots of different things where you get a feeling like there's opportunity here. A lot of cases I wouldn't feel like there was opportunity, and I wouldn't try too hard. I'd move on. But in a lot of cases there were. And it is amazing. I've had people come down in huge increments. Usually, if someone's ready to come down, let's say we're talking about something that's under 200,000. Let's just start there. Let's say they have a property at 180,000. I have regularly had someone come down by my first aggressive offer. Even though I was trying to get them to say no, I regularly had them come down as much as $50,000, just for saying a sentence. And then I'll come around. I want to see them come down. If they come down 50, I come up 10. That's where they start getting mad sometimes. But because it's amazing how much you'll get them to do the second time. It's never like the first. Not in my experience. I've never had them come down, another huge chunk. But sometimes you'll get another 10, 15,000 off. So I don't think it can be overstated. You come in there and cash is absolutely king. Most people are in a hurry for one reason or another. Usually if you have your own cash, usually you're not in a hurry. That's why you have it. The beautiful thing about what Justin and Eric are doing is they're putting you in that position. A good position to be in. Don't waste it. Wonderful thing. I've had a few times in my life where I thought people were right on, and I didn't lowball them at all. But that's not too often. And especially right now, everything is crazy, out of sight, overpriced. And I shouldn't say everything, but many, many things are just, people are just throwing real estate and acreage, around here and where I am in Kentucky right now, they're trying to get $6,000 an acre. Well, we'll see. If I was looking to buy property, I would be like a tiger. I'd just be in there shaking them for all I could to see what I could get them come down to. I got to where I didn't do any debt a long time ago. But if someone's going to go out and do debt, what these guys are offering is phenomenal. Put you in a wonderful place.
Thank you, Jeremy. Appreciate that. And you kind of reminded me of the duck analogy, if you've ever heard of that, where like you look at ducks and they're calm and composed on the surface, just gliding smoothly, but underneath the surface they're paddling like crazy. Like internally, like when you're giving the seller those offers, you're like a bulldog giving them a super low offer, but externally what they can see. And I think the right attitude to have with it is essentially the attitude that you're portraying. It's like, hey, you've got this $100,000 house and you're going to offer 60K or whatever. You're not just saying like, hey, 60K, take my offer right now. You're not doing the hard sell, like take this. You're just being like, hey, I know that you wanted more for this property, but I've got 60K cash. That's all that I got. I'm ready to close right now. I'm ready to just pay 60K, but that's all I can do. So take it or leave it. If you want it, here it is, And then people are like, oh gosh, that sucks, but that's all he's got. And if I want to just remove this headache in a day because he's already ready, not wait 30 to 45 days for financing, then I'll take it.
Yep. For sure.
Love it. And Jeremy, you've done this numerous times with your own cash.
Yeah.
You've done it. How many times have you done that now? You've done it with land, you've done it with houses.
I I'd have to go back and just go through the paperwork. It's not, guys you run into left me in the dust, but I wasn't really doing what they were doing. I was
Right. Yeah.
but I mean, it's been probably 10, 15,
Yeah.
maybe 20 times. And a huge number of those times I had extreme success.
Yeah.
It just propelled me forward in life.
Yeah. Well, the crazy thing is, like, all it takes is one yes, right?
That's
Kind of
right.
like in business. Like, I can have 100 different business ideas, and Justin's great at filtering my ideas and keeping the best ones. But for all the different things I want to do, with 100 of them, all it takes is one of them to be wildly successful. I mean, it also takes some focus and not trying to do 100 different businesses at once. But all it takes is one concept to work incredibly well, and then you've got a business. And same thing with putting offers on a house, right? If you put in 10 offers, that might seem like a lot, but that's really not that much.
Right.
Especially for somebody who's hungry, going after lots of real estate deals. If you put in 10 offers and you're like, well, I was wanting to get one at 60% of its value, 70% of its value, as is, whatever, and I put in 10 offers, nobody really wants to budge. If you just kind of give in and pay full market price, that's going to really slow down your real estate trajectory, because you have to, you don't have any equity built in already. But all it takes is one yes. So if you put in 100 offers and you just keep searching, turning over every stone and looking around every tree, like putting out as many possible offers in your target city as possible, you're going to find that one person who's super motivated, especially for a low cash offer. We've got people all across our communities convincing people to do these ridiculous 0% seller finance for 40-year deals. And some people are so motivated, they're like, sure, take the property, give me 0% interest, just pay the principal for 40 years, a tiny little amount. Like, if people are that desperate to take that, then they'll definitely, way before that, just take a low and simple cash offer, put the money in their pocket, and leave. So don't give up. Keep spitting out tons and tons of offers. You'll find that one that works.
I want to point out one of the other things Jeremy said that was really, really good is being able to learn to listen really carefully to what are their motivations, Pace talks about it all the time, and he compares it to the bunnies. He talks about their bunnies, and he tells his bunny story about how the lady was resistant because she didn't have a solution for some pet bunnies that she had in the backyard. And so as soon as he was able to solve that problem for her, she was interested in a solution for her home, and he was able to provide both.
People's motivations are, if you just start scratching the surface, it will blow your mind. It's all over the place.
Yep.
Sometimes the slightest little thing will open up just massive doors, and you'll be like, I can't believe that this person was coming from that direction. If you get past all the polite, not impolite, but just the standard polite, non-communicative way that modern life works, and just start talking to people and listening carefully, it's amazing what you'll find out and what things you never dreamed of.
Yep, for sure. Thank you, Jeremy. Ben, you got another question there?
No, sorry, I didn't realize I had that up.
Oh, no problem. How about Brenda, Geraldo, Erlene, Norm, someone else on here? What questions do you guys have about this, or what comments, what stories can you tell us?
Can you see me?
Yes.
Yep. Hey, Norm, how you doing?
Michelle.
Hey guys.
Wait, that's Michelle.
Yeah,
Hi.
she wants to say hi.
How's it
Sorry, I
going?
just walked past him and saw what he was doing. And I was like, wait.
Good to see you.
Good to see you guys too.
For real this holiday.
So
Awesome.
it's great to see you guys.
Yeah.
Yep.
Awesome.
Thanks for
What are you guys doing? What are you working on?
We are actually we're in Scottsdale right now. We're getting ready to go to Pace's event, but we were doing an RV underwriting class here in Scottsdale, and Norm was staying in one of our units at the villas.
Awesome. Cool. Oh, is
I was
this
learning how to underwrite better.
is this your special event that you guys are doing?
Yes.
Okay.
Yeah.
Is Seth Haley there?
Yes, actually.
Yeah, He left last night.
I was
Okay.
gonna say, he was here
Oh.
yesterday, and I think he left last night after
Love
the
it.
event. Yeah. Great guy. Really enjoyed talking to
My
him.
next door neighbor.
Oh, is he really? He said that you guys were close. Yeah.
we've been friends for many years, but he's got a visionary brain if I ever saw one.
Oh my
Small
gosh,
world.
beautiful photographer.
Mm-hmm.
Yeah.
So sorry guys, I didn't mean to like jack that. I just wanted to say hi.
All
No,
good.
no,
Good to see you,
thanks-
Michelle.
thanks for hopping on. Good to see you. Have a good
Crazy that
time.
it's such a small world. He's
Yeah.
telling us, oh, one of my friends was in sub 2, and he told me I had to come to the RV training, and it just happens to be you guys.
Yeah, for sure.
I have a thought on what Kevin was saying earlier.
Yeah.
I've hung on to properties, Kevin, in the situation you're talking about, just to, and you probably already thought of this, but just for the long-term capital gains, tax avoidance, or at least the lowering of the tax rate. In the state I was in at the time, the whole land contract setup was pretty good. And so I made use of that. People just lined up to pay me so I could save on taxes. So there's that.
Yeah. Kevin is from Michigan, actually, Jeremy. So
Oh,
yeah.
okay.
Mm-hmm.
45 years I lived there.
All right, go Lions.
Yeah.
Cool. Who else has questions? I know we got quite a few folks on here. People that are doing deals. Norm, did you have a question, or were you just kind of popping on to say hi?
Well, I'm here to just see more about how you guys do it, and eventually I'd like to have enough money to either lend myself, or in this case, probably give it to people like you. I don't even know if you do that, but give it to people like you.
Yep.
And get a return, a good return. So what would that look like if we start lending to you? Because you guys already have processes and things in place where with what I'm doing, I don't have time to go start another business, right? So like, you guys are getting phenomenal returns. Do you guys take, obviously you use other people's money. So how does that work? That would probably be more of what I'm interested in, but I'm always here to learn. I'm trying to raise 2.2 million right now, and I got to have it quickly, but I also have to make sure I've got money in the game. So like, I love what you're doing as a guy lending. I'm not always the guy that will like, oh, I can pay your guys' rates, because I'm like, man, there's just not that much in this deal. But and because I've not a newbie that has to have that crazy money right now, but there are definitely times where I see like, I know I'm going to end up doing a deal with you guys at some point where I'm like, I've got to have it. I'm willing to pay that fee. It's an opportunity cost. If I look at it as an opportunity cost, it's totally worth it. If I'm like, that's crazy high rate for a normal loan, hard money loan, then it doesn't make sense. If that makes any sense to you.
Yeah, that totally does. And one thing I would say is like, the best scenario for you is if you can just negotiate with the seller to say like, hey, I can close you rapid fast, but if you can negotiate it, for example, 5 or 10% lower on the purchase price because you have a rapid fast cash close, and then within 3 months you can refinance it or capital raise for longer term partners or whatever. If you can get in and out in 3 months, then it's 10% flat, which is our lowest rate for the 3-month rate. And you can get funding probably cheaper, but once you factor into like prepayment penalties and the processing fees and all those things, like the only fee that we have is that 10% at the very end. That's it. So, it's not that much more once you count in all the additional fees that the other ones would charge. So in that kind of situation, it makes sense. And for putting your own money into the deals, we have some, a lot of our standard deals are paying out around 17 to 18% annualized to capital partners. And some of the fast, big money, oddball deals are paying out much higher. It's just like a profit split where they get the lion's share of it and we get some as well. So for some unique deals, then we're actually quite a bit above that. But for our standard bread and butter ones, it's about 17 or 18% annualized to capital partners.
Yeah. So to maybe clarify what I was saying, so it don't sound like I was being rude. Is like when I have these fix and flips and I'm going to have them for 6 or 8 months, it doesn't really fit into your thing. Plus that makes it really high on my side where I can't just flip it in 3 months, but because it's not a product I could go refinance, right?
Yep, that makes sense.
Yep.
Until it's done, but then it's already 6 months or 8 months down the road, and so it's past your 3 months. So that's where that doesn't quite fit what you offer and what I got. But like on the stuff, if I had like a RV park that was already running, or an apartment complex or something that was already running, I could come in and close it out and then go out and refinance where it takes 3 months or something. And that's where that opportunity cost totally makes sense to pay that fee and get it going. If I'm understanding or explaining myself correctly.
Yep, that makes a ton of sense. Thanks for.
Like I wanted to borrow from you a couple times. I'm like, I just can't flip this in 3 months, or pay 30% annualized when the project doesn't have that big of a cushion in it. So
Yep. Yeah, that makes sense. And I think that it does make a difference if it's like a 4, 5, or 6 month project versus an 8 month project. Because at 6 months, we're at the 15% now. Like we talked about earlier in this meeting, we might be able to go up or down for certain scenarios later. But at the 4 months or the 5 months, it's going to be less. At the 7 and 8 months, it's going to be more normally. Jeremiah Smith, you had a hand up. I think you popped in and out. Are you still there, Jeremy? Maybe he popped out. Okay.
Looks like he keeps popping in and out. Maybe he's having internet issues. I know Brenda was getting ready to speak up.
Oh yeah, I did have a question just quickly. What is your lending box for like the fast cash deals? Because one of my goals that I wrote down was to collaborate with you guys and bring you guys a really good deal.
Awesome. Yeah, I think we can send you the flyer.
I'm gonna get it right now.
Yeah, Justin can put that flyer in Drive, and I've got that pulled up where I can just briefly share, not to toot our own drum too much, but this will basically tell you guys what we do and what borrowers can expect. It's a very, very quick way. So window, flyer, share. Okay. Can you guys see that flyer now?
Yes.
Yeah, so this is the way that we do it. And you can even white label this flyer, Brenda. So a lot of connectors or brokers, they will take this and just remove the 0 points because they're going to charge 2 points for them or whatever. But you can white label this, put your phone number, put your email on it. But this is basically what we tell them. And our target states are down there: North Carolina, West Virginia, Ohio, and Georgia. 0 monthly payments, 100% financing. And there's our flat fee rates there: 10% in 90 days, 15% in 180 days. We should probably even edit that to say like lightning fast closings as fast as 2 days, because we've done that several times before. We've even done faster than that. So that's one of the biggest selling points too, is that this is pretty much a cash offer. So you can use this flyer and this kind of material to start a conversation with the borrowers, and then basically say what we've been talking about, what Jeremy's been talking about. Like, even if you don't use us for every single deal, if you can come in like a bulldog and just boom, lock up a property for cash super low, then this is a very powerful tool in your tool belt to use.
But I think you're screenshotted, so I'll keep it saved.
I also dropped the link to the flyer in the chat there, so you're welcome to click that link and save a copy if you want.
Thank you.
Yep, no problem. Geraldo, tudo bem? Got a question from Geraldo. Go ahead. Geraldo, you still there?
Can you guys hear me?
Yep.
Yep, I can hear you.
My fault. I was on mute. I wanted to go back to what you guys were talking about, lending in a partnership. So I'm assuming you come in with the capital as a part of the LLC. And so my question would be, can you put stipulations there where you would take over the property if the borrower defaults or he's not able to complete the project? And would that hold in court? Would that hold in court if you're legally trying to circumvent usury. And I'll preface that question by saying I don't think you guys are attorneys, so I'm not asking for legal advice here.
Yep, this is 100% not legal advice, just Eric's experience. I do not recommend hopping on an LLC with the borrower. And if you talk with Abraham Gray, who's one of the most respected $100 million plus individuals, who is probably the most experienced lender in our communities, he also says the same thing in his masterminds. I do not recommend going on the LLC with a borrower. I've done that before I went to his mastermind. Before I knew as much as I knew, I did that and got burned on a deal. And I've known partners who have done that and got burned on deals as well. It sounds amazing and it can be a potential helpful tool, but you're basically a partner at that point, not a lender. Like, lenders are on opposite sides of the aisles. I've got my protections. I've got my promissory note, my deed of trust, my insurance, and all this. And even if the borrower does funny stuff or gets other liens on the property, whatever, I'm the lender. So I've got all these protections. And I usually get a lower rate, but I've got more protections. If I'm just a partner, like if Justin and I are off doing a fix and flip together, and then I go spend $20,000 on Beanie Babies or something else on that credit card, and I'm doing funny business, then as a partnership, it's terrible, right? Because if I'm racking up debt against a property, he's a partner. I mean, Justin can sue me, he can debate about it. Like, there could be some legal action to take there, but
and it doesn't even just have to be against the property, though, Eric. Like, if you're in that LLC with them as a partner, you're involved in all the financial dealings of that thing. So they could get just a business credit card and screw that up.
Yep, exactly. And actually, what's interesting is we had, not us, but another lending partner that did a serious amount of money on a deal like this, where they just got on the LLC and they had an option to take over the LLC, but they didn't even want to, because the borrower got an additional line of credit, just like Justin is saying. And then if they would have taken over the LLC has got negative value. It's
Right.
underwater. So the LLC, it is a way for the partner to just say, like, okay, here, go take the LLC. But if they're willing to do that, then they might as well just do a deed in lieu. It's like the same thing. Hey, here you go, take the deed, you get it. So there's not really a upside that makes sense, and the downside is huge. That's why we don't recommend the LLC method. Does that make sense, Geraldo?
Yeah, makes. So would you guys not recommend also lending as a partner? Because so does lending as a partner always mean you go into LLC, or it's different?
So when we've done it, we've always done the co-lending model, where, for example, like if Justin has Vesba LLC and I've got YA Solutions LLC, like if we're both going to lend on something, then we would just both have our LLCs on the documents. We wouldn't just create one joint LLC and then lend out of that. It's cleaner and separated out that way for when there's more than one lender. However, this gets different if you're doing a fund. Like, we're not talking about funds. We're not in the fund space. If you've got like 10 different people bringing in $100,000, that's a fund. That is very messy, and you've got to be very, very careful about registering with the Securities and Exchange Commission and just doing the private placement memorandum. Like, there's a whole legal process and thousands of dollars worth of paperwork you've got to do a fund. And we are not a fund. We're just us lending our own money, or a money partner coming in as a co-lender.
Makes sense. So, I mean, in summaries, the best thing is just lending with the lien position, and that lien position belonging to your own LLC.
Yes.
Yeah, that's the way that the states have prescribed it. Like, so many people try to be creative. When you're going to buy somebody's house and you're like, oh, well, they could seller finance this, I could take over this loan or whatever. Being creative of somebody buying the house is usually okay if you got the right, legal paperwork and structure and everything. Like, that's what's encouraged, and people do that all the time. They get great deals like that. Trying to be creative as a lender has gotten a lot of people burned, right? Like, oh, I'm not going to foreclose. I'm going to do this weird paperwork and try to find a legal loophole. Judges will see through that all the time. Like, you go in front of a Georgia judge, they're going to say, oh, well, why did you do this? This is a loan. So you tried to skirt around the process that I declared, that the state of Georgia has declared that lenders should follow. Why are you trying to skirt around what we have already established? You're not going to do this. I want you to go through the regular foreclosure process, or maybe you can't foreclose because the documents weren't right for foreclosure. They were right for your weird legal loophole that the judge just invalidated, right? So like the pre-signed deed in lieu and the LLC and statement of authority, like lots of other things. I've done pretty much all of it. And I can say that I don't recommend any of it. I just recommend super straightforward, simple, first position lien and foreclose if they don't pay you back in a state that you know you can foreclose on in a reasonable timeline. That's huge too, because some states, the poster children are California and New York, but there's tons of others. It could take years, plural, to foreclose and get your money back. So we avoid those states.
Makes sense. Thank you so much for the answer.
Mm-hmm.
Yep, no problem. We got time for some more quick questions. I see that Norm's got some, Ben has his hand up, and Jimmy Dane. Norm, go ahead.
All right, so I do have a project coming up that I possibly can flip in 3 months. We are meeting a whole bunch of people today, my interior designer, architect, contractor, realtor, all that stuff, so we can determine if what we have to change is going to require permits or not. Permits are going to screw us and we won't get done in 3 months, but if we can, you said there's a 3-month program. I guess I was more used to your 6. What are your 3-month program terms?
So 3 months is at 10%, and then
Flat
Justin
fee?
Justin might have to give me the exact numbers on the other ones. I think I have it right here. Like at 4 months, I mean, it doesn't just jump straight to
I've got
6
it.
months. It's 11.
11 and a half at 120 days, 13% at 150, 15% at 180, and 17% at 210. And all of our deals are underwritten for 7 months, so you can pay it out early at any time. It's just there's a step down discount essentially the earlier you pay out.
Yeah. So I say it in days because it's easier, or I say it in months because it's easier to think about than days.
True.
Pretty much like 3 days is roughly 10%, or excuse me, 3 months is roughly 10%. 4 months just goes up to 11 and a half. 5 months is at 13%. So if you're targeting 3 months for the 10%, and you miss it by a month or whatever, it's not like it's going to jump up to that 15. You're going to have marginally a little bit more for each additional month that it needs.
Okay. And then that's just kind of a matter of keeping in touch and communicating and like, hey guys, we're not hitting that. We are going to need an extra month or 2. And then it just increases that rate, that 1.5% each month that you go on kind of thing. It sounds like.
Yeah.
So you don't necessarily have to file an extension. It's just an automatic thing.
Okay.
Yep.
Very cool.
Like Justin said, every loan is basically written as a 7-month loan with early payoffs. So 7 months is what you got it. And then there's even grace period with late fees after that 7 months. But anyways, it's a 7-month timeline. If you pay it off early, here's what it is. 0 monthly payments. The only payment we ask for is a monthly update. So first of the month, tell us what's going on. If it's a bunch of rehab, send us pictures. Just keep in touch with us. That's all we get each month.
And are you guys, you're doing the rehab as a part of the funding, correct?
Mm-hmm. Yes.
So are you given, like if I say, hey, I need 2.2 mil, do you send all that today? Or do you say, hey, it's 1,750 for the purchase, and then we'll send you $100,000, you know, so maybe 1.9 today, and then let us know when you need the next 100 and you send it, or in increments, or what, how do you prefer?
So we do that in draws. However, we have overfunded properties where they're bought at extremely low loan to value. The typical method is we give the full purchase price, and then you guys go have the contractors do the work, and then they finish phase 1 of the work, whatever that is. They send the pictures. We get an inspector out there to just check it. I mean, once we have the evidence that it's done, it's a same day draw. So
backside, it's a backside reimbursement, not an upfront.
Right.
So that's where my trick is at on this, because I'm tapped out on 6 million of other projects. I need upfront funding.
Yeah. Well, if it's so, like, if you can buy a property super deep, then we can overfund the purchase, and we have done that before. So we can give you whatever 10-20% above the purchase price if our authorized loan at closing based on the underwriting supports it. Basically, if you bought the property at a really low loan value as is, we can overfund it and give you even some money in your pocket at purchase. The other way is like, since we're doing same day draws and we're lightning fast on that, you can have the contractor say like, hey, we're going to get this draw basically pre-approved so that the second the contractors finish everything, and I know they're going to be hungry, they're going to be bugging you, where's our paycheck, where's our paycheck? But the second they finish it, get the inspector in there, get the evidences done, boom, same day we send the money, so you can just instantly pay those contractors. And I would negotiate with the contractors that way too, because I wouldn't pay them like a massive amount up front. That's when you can get into trouble with contractors anyways.
Right. Yeah, we're purchasing at 175 mil, and its ARV is 295, and we believe will be about 450 total for rehab and closing and insurance and stuff. So grand total, we should be into it for 2.2, and it'll be worth 295. We're going in at 175, so it's a pretty good. I feel like it's a pretty good chunk, but you know, I don't know what your metrics are. So
sure, we actually Eric just threw in our loan analyzer. There's a video that kind of explains how we do our math. We try to be super duper transparent with exactly how we're doing our math, because I get it. You go to a hard money lender and sometimes you have no idea how in the world they came up with their numbers. But if you punch in your numbers, you'll know exactly what we're going to be thinking in terms of what we'd like to fund on that. So,
well, thank you very much.
Yep, no problem. Jamie Dang, how you doing? Hey Jimmy, can you hear us? Do you have a question?
Oh, my fault. Yeah, I got a question. So when you guys are talking about doing verifications of video or pictures, can it be from the borrower, or you need like a third party inspector to check it out?
So we have a network of inspectors that we've already have signed contracts with who can be there quickly. So I mean, in our target state. So basically, before the purchase, that inspector is gonna go and just double check, and that's really something that anybody should get anyways, right? So that third party inspector, they might find stuff like a foundation issue or mold or a roof problem that you should use to go and debate the price lower with the seller. But anyways, we'll have that person go and check, make sure the house is still standing, not a total. I mean, we've had cases before where the pictures are beautiful, but then someone goes in the house and it's full of mold and trash issues, and the inspectors pick up that kind of stuff. But usually the same inspector will do the initial inspection, and then there'll be the same person whenever you have a draw to just quickly walk it, double check, make sure that whatever the draw is for, hey, we did the kitchens and bathrooms, we want to draw for this, the inspector will just check it, and then we can prove that and wire the money for the draw.
Okay, and then it's dependent on the inspector arriving, right? So if the inspector takes 3 days, then it takes 3 days for them to come out there.
Yes, that's true. However, our whole brand and theme is lightning fast cash partners. So we pre-vet our inspectors and talk with them about being able to be ready very quickly so that they can go out there quickly to these projects. And besides that, for our target states, at least, we're not just dependent on one person. Like if that one inspector got sick or took a 1 week vacation, we've got others. So if it's something like, hey, we need an inspector here ASAP, then we're not just bound to one person's availability.
Okay, cool. And then does it have to be an inspector? Like say it was just like a quick fix. I've been talking to Justin about one in Vegas. And like if it's just like quick fix, quick picture, could I be the picture person, third party?
Well, we would love to do that, but the issue there is that you're kind of you're cutting yourself short, I would say, because like here's a personal story. There was here is let me tell you, sorry, I got a little track there. One of the homes I bought in Gainesville, for the original purchase price was $360K, Gainesville, Florida. And I was going back and forth on whether I wanted to get an official inspection. I'm like, well, the home looks great, it's fine, that I don't see anything in it. I paid, what was it, $400 for an inspection. They found some plumbing that was done wrong. They found a foundation. They found a lot of stuff that looked completely fine to me. And I've been in real estate for a while now. They found stuff that I was just thinking like, no way, this looks fine. And we actually got $20,000 off with the seller. So, I mean, even if the house is brand new construction and it looks perfect, people do new construction wrong. Brand new construction, a lot of times they're lower quality because the construction crew was just in a rush and they screwed up something on the electrical, the plumbing, like whatever. Even if it's a brand new, beautiful house, like pay the fee. In a lot of cases, it's not even like in Florida, I'm paying $400 or $500. A lot of our inspectors are as low as like $300 for just the investor's inspection. It's so worth it for the fee because it's a rare chance that even if the house looks perfect, they won't find anything that you couldn't negotiate several thousand down with the seller.
And then is the inspector, is that paid by the borrower or it would be through the draws?
Paid by the borrower.
Okay. By the borrower. And then you guys select the inspector, right?
Yes.
Okay. Cool.
But we give options, like in a lot of areas, like we're saying, we can have more than one. So if one isn't available soon, you can grab another.
Yeah. I mean, it's a list that we'll give you a few options, but yeah, it's inspectors that we've looked into.
Okay. And then when you guys are funding it or the purchase and all that stuff, is because you guys have to pay for TC and legal docs, is that paid out of escrow before everything
paid
is
up front?
Paid up front? Okay. Cool. And yeah, that's all the questions I got.
Yep, they're our TCs, but they're third party and they have their own company, and so the expectation is they receive it up front for the services they begin rendering right away.
Yeah. To any fee that the borrower gets charged, like, when you're closing a deal, you need to have a clean title policy. It's a big problem if you don't, because there could be other liens and stuff that who knows what's on there. So for the title policy, that's going to be the title company charging that to the borrower, right? And there's other third-party fees like that, but we at Creative Cash Partners don't make any money. We don't charge any fees until the very, very end. That's why we argue that we're pretty much like a cash partner, because we only make a penny when you guys do. When you guys refinance, when you guys sell, that's when we make our money. When you do, we're in it for the long haul to the very end. We're not making anything up front.
Cool. Thank you, guys.
You bet.
Yep. No problem. Awesome. Well, it looks like we've answered the questions. Anybody, Jimmy, you got one more quick one before we hop off?
No, I don't. I just forgot to put my hand down.
Oh, okay. No problem.
Legacy hand.
Legacy hand. Yep. Okay, sweet. Well, you guys know where to find us to connect with us. Thank you so much for joining us for office hours. We appreciate you. We hope you guys all have an excellent weekend.
Thank you, gentlemen. I appreciate it.
Thank you, guys.
Thank
you, Justin. Thank you, Eric.
Take care.
Thank you.
Take care.